Hey, future billionaires! In this episode, we're going to talk about why so many people lose money in the investment market. If you invested $10,000 in the S&P 500 index in 1999 and never touched it, with an average annual return of 5.6%, by the end of 2018, your investment would have grown to $30,000. But there's another scenario. If you missed just 10 of the best performing days within the period, your returns would be cut in half. When it comes to investing, many people only think about buying stocks. However, the financial market offers a wide variety of tools. In the past, even buying stocks required going through a stockbroker. But now with advanced technology, you can handle everything with just a few taps on your phone. This has its pros and cons. A fascinating study shows that the rise of investment apps has led to more frequent buying and selling. This not only results in excessive poor trading decisions, but also smaller profits and higher taxes. Data shows that if you check the stock market daily, there's a 47% chance it's down. If you check weekly, the chance drops to 41%. If you check annually, more than 70% shows growth. And if you check once every 10 years, there's a 94% chance of seeing gains. In the past, all transactions required the involvement of a stockbroker, who would provide professional advice and act as a safeguard. But now people frequently check their phones to see whether the market is up or down, focusing more on the minute-by-minute fluctuations. This makes them more susceptible to emotional decision-making. Without professional advice, people are more likely to make poor decisions. Think back to the last time you bought stocks or made an investment. Whose advice did you follow? Was it an investment advisor? A financial analyst with a CFA certification? Or perhaps a friend who recently made money in the stock market? Or maybe it was someone on YouTube analyzing stocks, even though their main job is real estate? This reminds me of a tragic case from a few years ago. A 20-year-old high school graduate using the Robinhood stock app lost $730,000 and ended up taking his own life. Honestly, I was an early Robinhood user myself. I appreciate the platform because, without it, brokerage firms wouldn't have rolled out zero-commission trading by the end of 2020. It gave everyone a glimpse of what true profits could look like. This kind of healthy competition is great. But on the flip side, Robinhood made options trading and margin accounts accessible to almost everyone. A margin account is essentially borrowing money to trade stocks, often with the potential for overdrafts. These high-risk leverage trading methods, typically reserved for experienced professionals in the financial industry, yet have become so easily available to anyone. I remember back in college, hedge fund strategies like hedging were taught as a 3-month course. Just the options section alone took a full month to cover, and even then, the class had a high failure rate on exams. Now, many young investors not only lack the ability to handle high risks, but also don't fully understand options. Yet they boldly open margin accounts, borrowing money to invest. These kinds of potential investment mistakes can not only wipe out all your funds, but even leave you owing money out of pocket. Hopefully, investment platforms will soon raise the bar and require users to pass a basic investment knowledge test before enabling these high-risk features. At the very least, such a step would ensure users have some foundational understanding. On YouTube, there are countless stock analysis channels, which often leave people with a very unclear understanding of investing. Many also join Discord investment groups to learn. While learning about investing is a good thing, if most members in these groups focus on high-risk, high-reward strategies, I strongly discourage following their approach. I've noticed a few interesting patterns. 1. People pay more attention to tomorrow's market trends than the outlook for the next few months or years. 2. Most discussions center around penny stocks or stocks that have seen extreme single-day price swings. 3. There's more focus on stock prices than on what the company actually does, and ignore its future prospects or its financial reports. Do any of these points sound familiar to you? If so, correcting these behaviors could be your first step towards successful investing. These actions are essentially gambling, relying on high risks for high rewards. So, what kind of stocks should you look for when investing? Companies whose products or services are widely used and highly praised. Those with strong growth potential. Companies with reasonable financial reports. Always remember, investing is not about the stock price. It's about the company itself. If you don't want to work with an investment advisor, the most beginner-friendly strategy is buy and hold. Purchase and hold onto your investments for the long term. If choosing individual stocks feels too challenging, you can opt for ETFs, exchange-traded funds. There are many options like tech sector ETFs, financial sector ETFs, and more. When selecting an ETF, focus on two key factors, which is prioritize high returns and look for low fees. At the end of the day, investing isn't about chasing trends or the hottest tips. It's about understanding the value behind the decisions you make. Whether you're picking individual stocks or leaning on ETFs, focus on the long game and let time work in your favor. Stay patient, stay curious, and remember, success comes from learning and making informed choices, not from gambling on quick wins. All right, that's it for this episode. And if you found this video insightful, please like, share, and subscribe to the channel. Don't forget to hit the notification bell so you won't miss our next deep dive into the world of finance. Thank you for listening, and I'll see you in the next one.